All right, let's dive into one of the most powerful and honestly essential tools in any investor's toolkit, the stop loss order. Whether you're a seasoned pro or just getting your feet wet, really getting a handle on this is going to be key to protecting your portfolio and managing risk like a boss. You know the feeling, right? We've all been there. You're just watching the red on the screen, your heart starts pounding, and you just freeze. You have no idea if you should sell or just try to hold on. It's an absolutely gut-wrenching feeling. In that feeling, right there, that's the core of what we call the investor's dilemma. It's this constant battle between your logical brain and your emotional gut. And that moment of panic, it can be incredibly costly. So why is that? Well, it's because when we trade based on fear, we tend to make these really impulsive choices, right? Like panic selling at the absolute bottom or, holding on for way too long hoping for a miracle. These gut reactions can turn a small dip into a huge financial setback. But what if there was a way to take that emotion out of the equation? And this is exactly where our key tool comes into play. I want you to think of it as an automated, totally logical safety net for every single one of your investments. So, what is it exactly? A stop loss order is pretty simple. It's just an instruction you give your broker to automatically sell an asset if its price falls to a specific level that you've already decided on. It's your line in the sand. And how it works is actually super straightforward. First, you set your stop price. So let's say you buy a stock at $100 and you decide, I'm not willing to lose more than 10% on this. You just set a stop loss at $90. Step 2. If the market price drops and actually hits that $90 mark, your order gets triggered. And then third, that order instantly becomes a market order and it sells your asset at the very next available price. Simple as that. The best part about this is you don't have to be glued to your screen, watching every little price movement. Your strategy is just working for you, quietly in the background, protecting you from any major nosedives, even while you're sleeping. And the great thing is, this isn't just for the stock market. Nope, this is a super versatile tool you can use pretty much everywhere, from traditional stocks all the way to the wild, volatile world of crypto. Okay, so we've covered how to protect yourself from losses. That's huge. But what if a similar tool could also help you lock in your profits? This is where we can really level up our strategy. Just think about that for a second. A safety net that doesn't just sit there in one spot, but actually moves up as your investment grows in value. This is where we get into a more advanced and frankly awesome version of the stop loss. Let's break this down. A standard stop loss, it's static. You set it at a fixed price, and that's where it stays. But a trailing stop loss, now that's dynamic. You set it as a percentage or a dollar amount below the current price. And as your asset goes up in value, your stop price trails right behind it, moving up too. But if the price falls, the stop stays put. A trailing stop literally gives you the best of both worlds. It lets your profits run as high as they can, but the second that trend reverses, bam, it triggers a sale, locking in those gains you've made, all while protecting you from a big downturn. Now, as powerful as this tool is, it's definitely not foolproof. And to use it well, you have to understand the potential risks you're taking on. And that's a critical question to ask, right? Using any financial tool without knowing the downsides can be a recipe for disaster. So let's look at the main things you really need to watch out for. So there are two main pitfalls here. First, placing your stop loss too tight. If you do that, a totally normal short-term price swing could knock you out of a great investment right before it bounces back. And second, in really fast-moving markets, this thing called slippage can happen. That just means the market moves so quickly that your order ends up selling at a price that's actually below your stop price. So you end up with a slightly bigger loss than you planned for. So how do you avoid this stuff? Well, a great rule of thumb is to set your stop loss just below a key technical level, like a support level. That's just a price point where the asset has historically had trouble falling below. This gives your investment a little room to breathe and helps you avoid getting kicked out by just the routine market noise. So when you put all of this together, you can start to see that the stop loss is way more than just a technical command you're putting in. It's actually a fundamental part of a really sound investment philosophy. At its absolute core, using a stop loss is all about enforcing discipline. It forces you to figure out your risk tolerance up front, before your emotions can take over. It's like you're pre-committing to a logical plan. And listen, this isn't just for active day traders. Even if you're a long-term buy and hold kind of investor, having a catastrophic stop loss set way below the market price can act as your last line of defense against a true market collapse. It's there to help you preserve your capital.
And ultimately, that's what it all comes down to, isn't it? When you use them thoughtfully, stop-loss orders help you strike that perfect balance between protecting what you have and staying disciplined in your strategy. They're a simple tool for sure, but they're one that can fundamentally change the way you invest, for the better.